G'day guys, welcome back to the Devon Too Good investing channel. Today in this video we're going to be going over Tencent's first quarter 2022 financial results. We're going to be having a chat about how they did and what we can expect moving forward. So before we get into it, make sure you like this video and subscribe to my channel. So if we get straight into it, Q1 2022 revenue, it came in at 135.5 billion RMB, which is stable year over year and is actually down 6% quarter over quarter. And what makes up this revenue is it's pretty much split into three main categories. You've got your value-added services, which comprise of the social networks, the domestic games, and international games. And then you've got the second category, which is online advertising, which is comprised of media and then social and others. And then you have your FinTech and business services. So this is made up of their the WePay and their cloud service and their internet security service and just their services in general. So if we look to their value added services, you can see that it is stable year over year. We do have some mixed results. So we got social networks. This grew 1%. You got domestic games. It went down 1%. And then international games year over year, it increased by 4%. The slowdown in domestic games, that can be attributed to the change in regulations. Pretty much, children are only allowed to play 3 hours of video games per week. This is obviously hurt them a little bit. It's going to lead to less revenue. It's going to lead to less playtime overall. However, at least the under 18 sort of category is actually a fairly small category, and it's only hurt them minus 1% year over year. But we should see this domestic games segment get back into sort of year over year growth in the back half of this year, as that's when the new regulations came into play. If we look at online advertising, this is definitely the most concerning area of the business. It is down 18% year over year, and essentially this is due to challenging macro conditions over in China. You've had the lockdowns in Shanghai. You've got a lot of companies' headquarters and marketing teams actually based in Shanghai. You've got if you close one of your major cities, there's going to be a lot of companies that pull back advertising spend. As macro conditions worsen, as interest rates start to rise, companies are going to be a bit more reluctant to be spending money on online advertising, and that's essentially what we see here in these numbers. In terms of their FinTech and business services, this was their strongest segment of their business year over year. We got a 10% growth rate there, and it's now $42.8 billion RMB. So it is starting to get quite a significant part of their business. And if we look at gross profit, we can see that it has decreased as margins have gotten tighter, rising costs. Tencent have been hiring a lot of software engineers to grow their business. These guys cost money, and if these businesses aren't growing as fast, the margins are going to get squeezed. And you can see overall operating margin, it went down from 31.6% to 27%. So that is also reflected in the slower growth, as well as the higher spend on labor, essentially. I think this slide here really does remind us on how much of a behemoth Tencent really are. And they're pretty much a leader in every category in which they compete. They're the leader in games. They're the largest gaming company in the world, and they've got some crazy IP, which we will talk about soon. You can look at their long form video. They're number one by subscriptions. News, music, literature, number one. Mobile payments, number one. Cloud, number two behind Alibaba. Mobile browser, they've got the number one mobile browser. They got the number two mobile security. And then, of course, they've got Weixin and WeChat, which is the largest social network in China, and pretty much the whole of China who has access to the internet is using Weixin and WeChat. And then also they have QQ, which is sort of their legacy social platform. So if we dive into more detail on their value-added services, we can see the social networks. It only increased 1% year over year, and this is reflecting increased revenue from video accounts, live streaming service, largely offset by decreased revenue from music and games related live streaming services. As we know, the CCP has been cracking down on live streaming, so this shouldn't come as a very big surprise. And then I had total VAS subscriptions that grew 6% year over year to 239 million, which is just a really large number. And they extended their market share leadership with a video subscriber base of 124 million, where they benefited from strengthened IP adaptations of comics and novels. And then they grew their music subscriptions actually really quickly year over year to 80 million. And I suppose you could almost compare it to, the Chinese Spotify there. And then this video subscriber, you could almost describe it as Netflix, I guess. If we look into domestic games, they say there was direct and indirect effects of the minor protection measures. That's, what I mentioned before, how people under the age of 18 can only game up to 3 hours per week. And also the timing of different update releases on the games, such as League of Legends. If we look into international games, this segment's usually growing a lot faster than 4%. However, we have seen a slowdown, and this is largely due to sort of users spending starting to normalize post-COVID. Obviously, there was a bunch of stimulus that went around. There was a lot of people stuck inside, so people were spending more on games. Now, it's fair to say that it's normalizing. We can see that across other sort of gaming companies, right? Activision Blizzard had fairly lackluster earnings compared to what they would usually have. Even Corsair Gaming, they create gaming gaming headsets, gaming keyboards, gaming mice, all that sort of stuff. Even they've their revenue slowed down. So there's a lot of companies sort of saying the same thing in the gaming space at the moment. So as we spoke about before, online advertising, the revenue there decreased 18% year over year, and Tencent's management sort of blame it on the weak demand and regulatory changes. So weak demand coming from lockdowns and macro headwinds, and regulatory changes coming from the education sector and the real estate sector really struggling at the moment over in China. Obviously, the private education tutoring outside of school hours, that was banned, and we all know the troubles with real estate over in China at the moment. So a lot of those companies obviously aren't spending on advertising, so there's less demand for ads. And as a result, we've seen a decrease in online advertising. In terms of media, they were lapping over a tough sort of year-over-year comp where they had the Beijing Winter Olympics and other, sort of top-tier shows out. Obviously, Tencent are going to have to look at, releasing some better shows. So in terms of the FinTech services, they suffered as due to the lockdowns. If people are locked inside, they're not making, they're not buying, transportation. They're not going to restaurants. They're not buying apparel. And then e-commerce, if everyone's locked inside, there's going to be logistics issues. So there was headwinds there due to the lockdowns. In terms of business services, the revenue decreased slightly year over year. This is due to them getting rid of some of the loss-making cloud contracts that they have and focusing on contracts with higher margin to try to make the cloud business more profitable. This is obviously a strategic move from them. We'll see whether it plays out and whether they do get more profitable moving forward. So we can see on this slide here that the company has been reducing their CAPEX spend. This is likely due to the slowing growth. They're not wanting to spend as much at the moment. And we can see that their operating cash flow has declined 34% year over year. And their free cash flows declined 54% year over year from 33.2 billion to 15.2. So there you go. Obviously, if their margins get affected by these headwinds, growth isn't as strong, and they've spent a bunch of money, obviously the free cash flow is going to decrease. And I think when it comes to this business, you just got to think long term. Do you think this business has a competitive advantage? Do you think it's managed by a good management team? Are you happy with the valuation? What do you think it will grow? What kind of multiple do you think it will trade at? What's the balance sheet like at this company? And that's really what you got to think about if you're interested in Tencent or any business for that matter. Got to look out 10 years from now, and you got to think about how much cash can this business provide to me, and then you got to discount it at an appropriate discount rate, and then you got to look at what it's trading, and if those two, if what you're paying versus what you're getting is attractive, then you can make an investment. But guys, I can't tell you whether or not to buy this stock, because that's got to be up to you and your own research. That's going to be your own decision. But look, it could be attractive. It really depends on those factors I spoke again. Then, do you think this is going to be a short-term issue for Tencent, or do you think this is going to be a long-term issue for Tencent? But guys, thanks for watching. Have a good one, and I'll see you in the next video.